Good morning and welcome to Managerial Accounting for the spring 2022 semester. As always, we'll start with a look at our calendar at what's coming up. So we should be finishing up chapter 16 during class today. So the chapter 16 exercises should be submitted for grading by the end of the day if you have those done. And then on Thursday, the chapter 16 problem would be due, and also we'll be starting chapter 17. So the chapter 17 pre-quiz will also be due by the end of the day on Thursday. I have started going through the annual report companies that you chose for the project this semester. So some of you will already have seen your approval or a note from me. There were a couple people who have not yet chosen a company, although those people are not here live at the moment. I did send emails to a couple people. If you have not chosen your company, please make sure you do that as soon as possible. If you do not select one in the next day or so, I will be assigning one to you just so that everyone has a company. Last class, we continued our discussion of chapter 16. We had started that together the previous class, just a very brief introduction at the end of chapter 15. And so today we will be continuing forward with chapter 16. Before we get to the new part of the chapter, does anyone have any questions, anything you want to talk about, review from this chapter? Well, we will get right to it then. So last class, at the end of class, we were working on exercise 5 from chapter 16. So I have just re-entered my information. Yours should be saved, as you know, you may know. I'm not able to save my work. So yours should be saved and you should have completed up to the same point in the exercise. So this is exercise 5 for chapter 16. One second here. Okay. So I just want to briefly remind you of what we had done. I will also point out in the chapter 16 reference materials, you do have a link here to the traditional approach to overhead allocation. This is the process that we are going through. So I'll be describing steps 1 and 2 that we have already done in that exercise. And then what is left for us in part D is this step 3. So this is where you can come for more information about that. I would also remind you, we discussed that chapter 16 problem is due by the end of the day on Thursday. There is a video here related to that problem. And what I would ask that you do is try the problem on your own first. And if you get stuck, if you need more guidance, then come to this video and use that as a fallback to help you. Of course, if that still doesn't help, doesn't get you to where you want to be with that problem, just let me know and I'm always happy to help. But first step is try it on your own, then use the video, and then ask for help if you need it. So looking at exercise 5, as I said, I'm just going to briefly go through what we already did. And these are the 3 steps in the traditional allocation of overhead. What you'll see in an upcoming chapter is that I don't know if you want to call it the modern compared to the traditional, but in the traditional approach, we had just one overhead cost pool, one cost driver, one step allocation of that overhead. A more, if not more efficient, but maybe a more precise way of allocating overhead is to have multiple cost pools, each with their own cost driver. And in chapter 18, which is the last chapter on our first exam, if you're keeping track, if you're looking ahead. In chapter 18, we'll talk about activity-based costing, which is one version of a more updated approach to allocating overhead so that we have a better handle on where our costs are coming from. But as I said, here we're using the traditional one-step approach, one cost pool, one cost driver. And for these two factories, we were told that factory 1 had chosen as their cost driver machine hours, and as for factory 2, they chose as their cost driver direct labor hours. Neither one of those is better or worse than the other, they're just different. Each company is deciding for itself what is an appropriate cost driver to use. So in step 1, then, thinking back to the description that's in Blackboard for you, the traditional approach, step 1 is to calculate the predetermined allocation rate based on our budgets. So for factory 1, we took the estimated dollars of overhead and divided by the estimated level of the cost driver, the estimated number of machine hours, and that's where the $14.80 per machine hour came from that we did last class. For factory 2, then, they took their $44 million budget and divided it by their estimated direct labor hours of 800, and that's where the $55 per direct labor hour came from. That's step 1. Determine how you're going to allocate the overhead. Step 2 is what we do here in letter C. Again, we did this together in class last time, but letter C is actually allocating the overhead based on the actual level of the cost driver during production. So production starts and we are measuring, we're counting, we are evaluating the number of machine hours or the number of direct labor hours. And for each machine or direct labor hour, we allocate overhead based on the rates we established in letter A in step 1 of the process. And so for factory 1, we are told the actual machine hours for August were 105,000. So for each one of those 105,000 hours, we assigned or allocated $14.80 worth of overhead to work in process. And that's what you see happen here. For factory 2, they had actual direct labor hours of 64,500. Multiply that by the $55 per direct labor hour that we had determined or budgeted that we would allocate. And that's where this journal entry comes from. So this is the assigning or the allocating of overhead based on our predetermined overhead rate and the actual level of the cost driver, the actual machine hours or the actual direct labor hours. So remember, these rates are based on estimates. We've estimated both the dollar amount and how many, in this case, how many hours, how many machine hours or how many direct labor hours. It is highly likely, almost a certainty, that both of those are not exact, right? We might be close. We might do a really good job of estimating, but the chances of us estimating both of those quantities, the dollar amount we're spending, the actual number of hours we're working, the chances of getting both of those to the money is about 0. And so that's where step 3 comes in, and that's what we still need to do here in part D, the part that we did not complete together last time. Before we do that, does anyone have any questions about what we had already done, step 1 and 2 in this exercise? And if you were here, you should have already had those numbers saved in your exercise. So let's move on then. Letter D here is step 3 in the 3-step process that I've outlined for you on that page in Blackboard. Determine the balances of the factory overhead accounts for each factory as of August 31st and indicate whether the amounts represent over or under applied factory overhead. So because we use an estimate and we have every reason to believe that estimate is not going to be perfect, we have to, at the end of this process, determine how good we did, how well we were, how well we estimated, and make an adjusting or a correcting entry. Very much like the adjusting entries that we learned about in chapter 3, way back in financial accounting. Let me get my annotate function on here. And so for factory 1, give me a moment here because I don't want to have to take that off the screen, but I don't. There we go. Okay, so now I can see, you may need to scroll up. I've got something on my screen here that's kind of blocking my view. Actually, that would have helped. So now I can see it. The actual factory overhead costs for August. So for factory 1, the actual overhead costs were $1,515,800. Well, how much did we apply in part C? $1,554,000. We applied more than they actually incurred, right? We overestimated what our costs would be, and so we applied too much. We would say then that these are over applied. And for factory 2, their actual costs were $3,600,300, and that's given right at the top of my screen right now. And the amount we applied was $3,547,500. So in the case of factory 2, these costs are under applied. We did not apply enough overhead. And so what we're going to do to fix these is make a correction to the overhead. Let's fill in the, let's fill in our blanks here first. So let's see, 1,515,800. So I'm trying a new calculator today, and I am not very proficient at it yet, but I'm confident it's going to be better than my cell phone calculator. You wouldn't think at my age I'd have to really think about how to use a calculator, but the buttons are just not in the same place as my calculator I've been using literally for 30 years, longer than most or all of you have been alive. Pretty old calculator. So now we have to figure out whether this is a credit or a debit balance. So let me just draw a T account on the screen here. We'll only do this for one of them because you'll get the idea. Okay. You can do it for both if we need to. So this is going to be the work in process account. Remember, that's where overhead gets applied. If you look back at that flow chart that we have in the chapter 15 folder, you will see that overhead is applied to work in process. You can also see it here in our journal entry. It gets added to work in process. So let's draw another. Actually, I think probably the easiest thing to do is to, rather than have this be the work in process account, we'll have this be the factory overhead account. It will be more straightforward, a little bit easier for us to see. So let's think about how this happens. As we are incurring factory overhead, we add those actual costs to the factory overhead account. Again, if you go back to that flow chart in the chapter 15 folder, you will see that we've added into that account depreciations, supervision salaries, indirect materials, property taxes, insurance, all those kinds of things that we're not tracing directly to a specific product. So the actual costs are debited to the factory overhead account. And then you can see in our journal entry here that when we apply overhead, we credit it to factory overhead, we remove it, and we add it to work in process. And so on the credit side of this account, we have the applied overhead. Okay. So if our actual costs are higher than our applied costs, we will have a debit balance in this account, right? Everyone agree with that? If our applied costs are higher than our actual costs, we would have a credit balance in this account. So for factory 1, our actual costs were lower than the applied, so we would have a credit balance, right? It's over applied. And in factory 2, because the actual costs were higher than the applied cost, our balance at the end of the period would be a debit balance, and those costs are under applied. We did not add enough, we did not apply enough to the product. So those are the answers to this exercise, and we can, if you want, go ahead and click the check my work button and get your green check marks in there, get credit for that. But I need to spend a little bit more time talking about, so what do we do with this? So we know that we aren't perfect. I know, it's a surprise. We are not perfect. Our estimates were not spot on. So the question is, we know now how to determine what the balance is, what's left in that factory overhead account, whether it's a debit or a credit balance, whether that means over or under applied. We've talked about all that. But the question you need to answer now is, okay, so what do we do about it? We know now what the difference is. We know what our error was. How do we go about fixing that? And at this point, I do want to go back to the chapter 15 and just pull up that flow chart that I keep mentioning. Here it is. I think I can erase my drawings on the screen at this point. We won't need those any longer. So let's take a look here. So it's the overhead that's in question. It's the overhead that we were not perfect in allocating it. So let me ask this question. At the end of the month, where is that overhead? Well, we applied it or allocated it here. This dotted line represents the allocation. So the work in process includes the overhead, right? It includes direct materials, direct labor, and overhead. But where else is it? Well, we hope that sometime during the period, we finished up some of the stuff we were working on. And when we finished it up, it moved out of work in process into finished goods. So some of the overhead is already attached to the products that we finished and is sitting here in the finished goods inventory account. But again, we hope we didn't finish up a bunch of stuff and not sell any of it. We hope we sold some of this product. And when we sold it, what happened to it? It moved off our balance sheet altogether and moved on to the income statement as part of cost of goods sold. So at the end of the period, when we're doing this reconciliation, when we're trying to adjust for our error, our lack of perfection in estimating, when we look at this, where is that overhead? Some of it is still in work in process, some of it is in finished goods, and some of it is on the income statement as cost of goods sold. Is there anyone who does not see that? Our overhead is in all three of those places at the end of the period, right? Okay. So if we wanted to be absolutely perfect, if we are not willing to, if you're one of those people who doesn't want your checkbook, most of you probably don't even have a checkbook, and if you have one, it's almost certain, because I ask this question frequently of students, it's almost certain if you have a checkbook, you don't actually balance it. That you probably use the app on your phone and look at the balance that the bank says you have and say, okay, that's close enough. Because you're probably not writing a lot of checks, you're probably using debit card more than anything else. But if you're one of those people who really insists on everything coming out to the penny, then you would be inclined to go back to each one of those places, work in process, finished goods, and cost of goods sold on the income statement, and fix our estimates and make them perfect. How would you do that? You would recalculate what the actual overhead was. Remember, we estimated at the beginning of the period based on what we thought we would spend and how many, in this case, how many hours we thought we would work. Well, at the end of the period, we know how much we spent and we know how many hours we worked. So we could come up with the exact overhead allocation rate and go back and fix it in each one of those three spots. In accounting, I do not mean to imply in accounting that we don't care about pennies, we don't care about accuracy. That is not what I'm saying at all. However, the bigger concern for us in accounting, I'm going to put this term on the screen. The bigger concern for us is the concept of materiality. And most of you have heard me use that term before. Materiality means, is it big enough that anyone cares? Is it big enough that it matters? And what would make it matter? Well, if it's big enough that a decision maker who's using these financial statements would come to a different conclusion about our company if only they knew the exact overhead. So is it big enough to matter? Is it material? And our rule is going to be if it is more than 5% of the total. If our error is off, if our estimate is off by more than 5%, we're going to say that's big enough that it matters. And if it is a material error, then we need to do what I just described. Go back to each one of those places, work in process, finished goods, cost of goods sold, and make a change, adjust, or correct our overhead. In all three of those places where you will find that overhead that we did such a poor job estimating. Let's go back to our exercise then. Are these material amounts? So what if I look at the first one, 38,200 as a percent of the total. So I'm going to divide by the actual overhead, 1,515,800. 2.5%. 2.5%, our error is 2.5%. So we weren't great at estimating, but it doesn't rise to the level of being material. It's less than 5%. So we're going to say, you know what? We don't have to go back and fix it in all three of those places. We're going to fix it in just one place because it's easier, it's more efficient. We're going to fix it in just one place. And the one place we're going to fix it is where most of the overhead is. So if we go back to this, we know that some of the overhead's in work in process, some's in finished goods, and some is on the income statement. We hope that the majority of that is in cost of goods sold. If we're doing a good job with controlling our inventory, we hope that at the end of the period, most of the stuff we made this period has already been sold, that we're not sitting on a whole bunch of inventory. We'll be talking about that later on in the semester, in a later chapter as well. The concept of just-in-time inventory and lean manufacturing. So that will be a topic for another day closer to the end of the semester. But I hope, just with what we've learned about inventories, even from financial accounting, as we talk about inventory carrying costs and the inventory turnover and trying to make sure that we are being efficient with our resources, we hope that at the end of the period, the majority of our product is not on the balance sheet, but it's on the income statement as cost of goods sold. And for that reason, the adjustment will be done to cost of goods sold as well. So what would that look like? Well, we're going to move whatever's in the factory overhead account. We need to zero that out. So we're aiming for a zero balance in the factory overhead. So for factory 1, our factory overhead account has a credit balance at the end of the period. So how are we going to make that 0? How are we going to zero that out? What do we need to do to the factory overhead account? If it has a credit balance, we need to, so we need to debit that account. We need to add money to it, right? We over applied the overhead. That means we took out more than we put in. And so we need to, oops, there we go. We need to debit factory overhead, or as Drew said here in the classroom, we need to add money to that account because we took too much out. So we're going to debit factory overhead. Because it was not a material error, because it was less than the 5% that we're using as a guideline, the credit would simply be to cost of goods sold. If this was a material error, you would have, in this case, credits to cost of goods sold, but also to work in process and to the finished goods. And we would have to divide up that 38,200 equitably between those 3 accounts, or excuse me, among those 3 accounts. For factory 2, we can do the math, determine if it's a material error. It's not. And our change, our correction, the entry would be reversed. We underapplied that. It has a debit balance. So to zero it out, we would need to credit factory overhead and debit cost of goods sold for the 58,800 that we were off in that estimate. And so now we've gone through the entire process, all 3 steps of allocating factory overhead under the traditional approach. Before we even start production, we decide what our cost driver is going to be, and we calculate a predetermined overhead allocation rate. During the production process, we apply overhead based on that predetermined rate and the actual level of the cost driver. In this case, the actual hours worked, or direct, what was the other one, machine hours or direct labor hours worked. And then in the final step, when we're done with the period, we need to make an adjustment because we're not going to be perfect. If it's material, we need to make it a little bit more complicated. If it's not material, if it's less than 5%, we do as we did here and simply make the correction or adjustment in cost of goods sold. Whatever it takes to zero out the overhead account. And so what you can see is when we had over applied overhead, the impact or the effect of this adjusting entry is to lower our cost of goods sold, right? Cost of goods sold is an expense account. So when we credited that account, it actually lowers the amount that's left in there. Why did we do that? Because we put too much in there in the first place, so we had to pull some back. Questions on this exercise or anything else at this point?
So, assuming it's the same business that owns both factories, would they have like, so first would they have like an overall overhead account, which then would be subdivided into factory 1 and factory 2?
They would likely have separate accounts, so it would be factory 1. Where I thought you were going was, would there be an overhead account that covered both, like an administration or a corporate level? And yes, they would, but it probably would not be a product cost, it would be a period cost. So those selling administrative kind of costs. So it probably is, you know, a corporate headquarters, and the costs of that corporate headquarters are going to be allocated to the divisions or the factories in this case, but they would really have to keep those factory costs separate.
Okay, because what I was kind of trying to get to too was if they budgeted, if these were both in the same, we'll say, area of the budget, we technically have an extra roughly $20,000 that we planned on spending that we didn't.
Right.
So I didn't know how much, if it would be shortcut to that, or if it would be well, we're minus almost 40 to 1, and we're plus almost 60 elsewhere if it was divided more fully than that.
So that's a really good question. And remember, so this is managerial accounting. These are not publicly available. You know, this information is proprietary, it's internal. A company could choose to have one overhead account. The decision about that would be based on a couple different things. One, it's clearly more efficient if they have just one account. It cuts down on, you know, the accounting entries and the separate accounting systems and so on. But, and this will keep coming up in future chapters as we talk about how do we use this stuff to make decisions. So the question they would have to ask is, if we keep them separate as we have them here, if we keep them separate, is it going to give us better information for our decision making to know how to run our business? And if they have determined, no, the costs are pretty much identical and it's okay to lump them together, then it's more efficient. If it doesn't give them better information, then there's no reason to take those extra steps. But only the company can decide that. There's no right or wrong answer. So I can't give you just one answer other than I'm assuming, or in this case, that they had a reason for keeping them separate and for using different cost drivers for the two different factories. Certainly if they were combining them, they'd have to have just one cost driver as well. So I'm assuming that for some reason, it makes sense for them from a decision-making process, which information is going to be more helpful, that they decided, they made a deliberate decision that having these separate is worth the extra work because it gives us better information.
And especially in this example, because the one is all machine hours and the other is all direct labor hours, like definitely makes more sense. Whereas if it was a closer mix between the two of them,
if they were using the same
roughly
cost driver.
the same proportion of hours,
Yeah.
then it'd be a lot closer for accounting purposes too.
Yep, absolutely. And when we get to activity-based costing in chapter 18, you'll see a little bit more of how that could work, that there could be some, because in activity-based costing, we have a separate cost pool for each activity that we identify. So the way you're describing things, if we have this corporate level where maybe the order taking, the order processing is, or the billing and the receivables are all handled at that corporate level, then that one activity could assign costs from that one cost pool to both factories. Where there might be some cost pools that only for factory one, you know, something that they have to do there or that they do differently, and so they might have an activity pool for factory one for cleaning, for, you know, maintenance stuff, because that really is factory specific, where the order taking is at the company, you know, the facility, the corporate level. So there are definitely ways to get at that. All of that adds an extra layer of complication, and so they'd only want to do that if it actually helped them make a better decision, know exactly or more closely what their actual costs are for doing business. As of now, but not any longer after this semester, we have a class called Advanced Managerial Accounting. And in that class, we do get into using this kind of information to make a decision. We have two factories and they both make the same product. How much should we be making at each factory to maximize our profitability? Because we can't make everything we need at just one factory. We need to have both of them, but how do we split it up? Do we have them each make half? Do we have them concentrate production at one facility versus the other? So. Any other questions? Any other questions at this point? I'm sure I've got everybody marked here. Attendance, okay. All right, let's move on then to our next exercise. predetermined factory overhead rate. Puyallup Medical Center has a single operating room that is used by local physicians to perform surgical procedures. The cost of using the operating room is accumulated by each patient procedure and includes the direct materials costs, physician surgical time, so that's direct labor, and operating room overhead. On January 1st of the current year, the annual operating room overhead is estimated to be, and you can see the different costs that are going in there. All of those are things that we have discussed. We have indirect labor. We have indirect materials, those supplies, depreciation, and utilities. The overhead cost will be assigned to procedures based on the number of surgical hours. So they've identified their cost driver is surgical room hours. Puyallup Medical Center expects to use the operating room an average of 8 hours a day, 7 days a week. In addition, the operating room will be shut down 2 weeks per year for general repairs. So the first thing I want to know, we already know the expected or estimated overhead is $812,000. But I need to determine, I need to do some quick math here to figure out how many hours they expect to use the room. So 8 hours per day times 7 days per week, and they're going to be open 50 weeks per year because they're closed for 2 weeks for general repairs. So 8 times 7, 56 hours a week, times 50 weeks out of the year. That's 2,800 operating room hours is what they expect. Everybody okay with that? Agree with that number? So now for letter A, we're asked to determine the predetermined operating room overhead rate for the year. So this is step 1 of the overhead allocation process as you have it in Blackboard. Step 1 is the estimated overhead cost, $812,000, divided by the estimated level of the cost driver, 2,800 hours. And so I found $290 per hour is how much overhead will be allocated. Is that what you got? Okay. Yes, right. It's actually my second day with the new calculator, so I'm just looking for validation. Letter B, Bill Harris had a 5-hour procedure on January 22nd. How much operating room overhead would be charged to his procedure using the rate determined in Part A? So 5 hours at $290 per hour. 5 hours at $290 per hour. His overhead charge would be $1,450. I need to be clear, that does not mean that's how much we're charging the patient. That's how we're costing this service. So this is kind of an interesting, they call it the predetermined factory overhead rate, but we're seeing in this exercise that this same process can be used for a service company. A hospital, an operating room, a medical center is a service provider. They're not selling a product, they're selling a service. And so the same overhead allocation, again, I think it's funny that they're referring to it as factory overhead. You think of an operating room as a factory, and they're not making a product, but we can use the same process for a service company as well. During January, the operating room was used for 240 hours. The actual overhead costs incurred for January were $67,250. Determine the over-applied or under-applied operating overhead. So let's calculate how much overhead was actually applied. I'm going to put this up here to give myself enough room. So the applied overhead was 240 hours at $290 per hour. Which is $69,600. Hopefully that's what you got as well. $69,600 is how much we applied based on our estimate. Their actual costs were $67,250. Did we over or under apply the overhead? Did we apply too much or not enough? Over applied it. By how much? Well, I just need to subtract the 69,600 applied minus the 67,250, 2350. So that means, to go back to what we had done in the previous exercise, if we over applied the overhead, we have a credit balance in the overhead account. To fix that or to correct it, we would need to debit overhead and credit. In this case, not cost of goods sold, because again, we're not selling a product, but cost of services, if the company breaks out those cost of services separately. And we're done with that one. So go ahead and click check my work.
Cindy,
Yes, ma'am.
really quickly, can I ask where you got the 1,450 for letter B?
Yes, absolutely. So it says that it was a 5-hour procedure. So they're going to, he used the operating room for 5 hours. So 5 hours at $290 per hour. So that predetermined overhead rate times the actual hours work, in this case, hours used. 290 times 5 hours.
Thank you.
Yeah, you're welcome. Yeah, I didn't write that on the screen, and I certainly could have. Okay. So now you've seen that we can go through those same 3 steps for a service company, just like for a manufacturing company. Get those pictures off the screen. And we will keep moving. Exercise 7, entry for jobs completed, cost of unfinished jobs. So remember, this chapter is focused on job order costing. Our next chapter that we'll be talking about starting on Wednesday will be, on Thursday. I don't know what day it is. I do know what today is. I just forget what day this class meets. Really. So on Thursday, we will be starting chapter 17 on process costing. But this chapter, we're focused on job order costing, where we have one work in process inventory account, and we keep these subsidiary ledger cards for all of the jobs that are in process. When we finish up the jobs, we close out those cards, and that one work in process account is what I refer to as the control or the master account. So it's the total of all of those open jobs, all the jobs we're currently working on. And so when it tells us here that the following account appears in the ledger prior to recognizing the jobs completed in January, this is all of the costs that are in that work in process account. So we have our beginning balance and we know what was added to it, the 3 components that make up all product costs: direct materials, direct labor, and overhead. During the period, we finished these 4 jobs. 210, 216, 224, and 230, and we can see the total cost. The cost for each one of those jobs also will include direct materials, direct labor, and overhead. So when we finished those jobs, what happened? We moved them out of work in process and into finished goods. So how much did we move out? Well, the total of those 4 jobs. So let's just add those up. We're given the totals. Those totals already include all 3 costs, direct materials, direct labor, and overhead. And I found that total to be $562.40. Did anyone else match that number? So again, we know what was in the account, what it started with, what was added to it. We now know it was moved out. So how are we going to find the balance at the end of January? So these represent the debits to that account. Here we have the credit to that account. So really what we're doing is just finding the balance in that work in process account. Add up the debits, the beginning balance plus the 3 amounts that were added, and subtract the credited amount. Anyone have a total for that?
3794. Oh, hold on, sorry.
It's, let me say that didn't match my number, but
There, 277, 700.
that one I got. Anyone else have a total? So we're adding up these 4 amounts and then subtracting what was credited or removed from that account. Anyone else have a total? Ending balance for work in process? I got either. Anyone on Zoom have a number? You can post it in the chat if you want. 76, that's what I got, 76,760. Oops. So it should be, so we add these 4 numbers here and then subtract the 4 jobs, which we've already totaled to be 562.40. So as each one of these jobs was finished, it would be credited to work in process and debited or added to finished goods. I'm looking at my screen here. The numbers look like they are. Did you guys get that number now?
Yeah,
I could
I
just-
don't know what I did the first time.
You're not using your cell phone calculator, right? Because that's
I'm
the trouble.
using the one I. Still doesn't help if you put in wrong numbers.
True. Okay, so and that number is correct, but it should be beginning balance plus the 3 product costs that were added during the month minus the 4 jobs that were completed, which is this 562.40. And so that's where that number comes from. So that's what's left in there. I don't know what jobs that pertains to. They seem to have skipped a bunch of numbers in here. I don't know if those numbers are still in process somewhere. I don't know. The company would know. They have a job order cost card, a separate subsidiary ledger account for each one of the jobs that is in process. So the 76,760 is what's still in process at the end of January, and that may or may not be more than 1 job. Could be just 1 job, I guess. Everybody okay with that? And so it should be just, if you add up these numbers, 85,800 plus the three pieces that were added, direct materials, direct labor, and overhead. And from that total, subtract 564,240. Sounds like maybe you started with the 560,240 and subtracted those four. Subtracted the four jobs. That's how you could get to zero.
Yeah, that's what I did.
Okay. Yeah. Does that make sense though?
Not really. Well, I don't understand what I was supposed to do.
Okay. So let me just draw this real quick. So if this is our work in process account, without using numbers, I'm just going to describe what goes in there. So we have our beginning balance. We add to that the direct materials, the direct labor, and overhead. We subtract from it the cost of goods manufactured, to use that same term that we've used in the past. And what we're left with is our ending balance. Okay. So this is really what we're doing in this exercise. We have four debits. We have, and those are listed right here for us, direct materials. We have our direct materials. We have our beginning balance, our direct materials, our direct labor, and our overhead. Those represent the total of our debits. The credit is the amount that we finished and moved out to finished goods. And that's this total right here that we moved out of work in process because the jobs were completed.
I think I see what I did there. To get 560, 240, I added the four jobs and then I just I know now that I was supposed to just add all the work in process totals and
Yep.
subtract the four jobs from that total.
All right, yep. And then the ending balance is the unfinished jobs. They're still in process. That's why they're still in this account. Yep, good. Glad that makes sense. Okay, any other questions before we move on? All right, let's keep going. So our next exercise is entries for factory costs and jobs completed. Collegiate Publishing Incorporated began printing operations on March 1st. So the advantage of that is that there is no beginning balance. That's the reason they tell us that. None of these jobs were in process at the beginning of the month. Work in process would have had zero in there because the company didn't exist until March 1st. Jobs 301 and 302 were completed during the month, and all costs applicable to them were recorded on the related cost sheet. So that's that job order cost card that I was referencing. So you can see that each one of these has direct materials, direct labor, and the overhead has already been applied. These jobs went through work in process this month, but they were completed and moved into finished goods, and then possibly even delivered, sold to the customer, and moved off the balance sheet entirely and onto the income statement as cost of goods sold. Jobs 303 and 304 are still in process at the end of the month, and all applicable costs except factory overhead have been recorded on the related cost sheets, and you can see that here. Their direct materials and direct labor are traced directly to the specific job. In addition to the materials and labor charged directly to the jobs, $4,500 of indirect materials and $8,200 of indirect labor were used during the month. The cost sheets for the four jobs entering production during the month are as follows in summary form. Journalize the summary entry to record each of the following operations from March, one entry for each operation. Okay, so that means that we are not looking at the jobs separately. They're asking us to just add them all together and do one entry. So direct and indirect materials used. When we use materials, we would have to move them. When we use materials, we would have to move them out of the materials inventory. We know that there were $4,500 of indirect materials, and we have 4 different amounts here for direct materials. So all of those together, the indirect and the direct materials, would have to be credited to the materials inventory account. I'm going to start with that. Adding up the indirect materials plus the 4 separate amounts for direct materials. Anyone have a total for that? That is what I got. So all of that moves out of the materials inventory. If I were to go back to our flow chart here to remind us what's happening, so here's our materials inventory. As we use direct materials, they move into work in process, and the indirect materials get moved into the overhead account. And so that's what we need to do next. Some of it's going to go in work in process, and the rest of it's going to go in factory overhead. Because I like to make things as easy as possible, I'm just going to enter the indirect materials because I already know the amount for that. $4,500 for indirect materials. And then I just need to subtract, do one subtraction to get the amount for work in process. The slower, but just as accurate way of doing that would be to take each of the 4 direct materials that we have in the 4 separate jobs and add them up. And you'd get the same answer. Everybody okay with that? We're going to do the same thing for the payroll. And I'm going to pause the recording to allow you to try this part on your own. So do part B on your own. Keep in mind there's both direct and indirect labor. I'm going to pause the recording. Once you've finished part B, restart the recording. So looking at letter B, the work in process total is the 4 direct labor quantities for each one of the 4 jobs. The factory overhead is the indirect labor that we are given right here in the first paragraph. And then the total of those 2 labors is credited to wages payable, or to cash if we actually have paid it. Next, factory overhead applied to all 4 jobs. A single overhead rate is used based on the direct labor cost. So we don't know what the direct labor cost is, but we can determine that by looking at either one of the 2 jobs, job 301 or 302, to see what the rate was that they used. So to calculate that overhead rate, again, we can use either job 301 or 302. I'm just going to back into what the rate must have been. The factory overhead, I'll just use job 301 because it's the first one. It's also smaller numbers. So the factory overhead that we applied was $77.50 based on $31,000 in labor, direct labor. It tells us to use direct labor as the driver. And that would be 25 cents per direct labor dollar. Oops, direct labor dollar. There we go. So every dollar in direct labor, they're applying 25 cents in overhead. If you want to check that, you can try it on the factory overhead from job 302, 10,550 divided by 42,200, and you should find the same overhead rate of 25 cents per direct labor dollar. Everyone okay with that so far? So we know our direct labor, again, trying to make this as efficient as possible. We know our direct labor, we added those up already in part B, 106,800. So if we were applying 25 cents each to each one of those dollars, that would be a total of $26,700 in factory overhead. I'm going to repeat where I got that. I calculated the overhead rate based on the 2 jobs that already had overhead applied, 25 cents per direct labor dollar. We're asked to do 1 entry for applying the overhead to all 4 jobs. So I needed to know the total direct labor, and we've already calculated that here in part B, $106,800. So I took the actual direct labor dollars and multiplied by that predetermined rate of 25 cents per direct labor dollar, and that's where the 26,700 came from. Applying overhead, applying overhead means we move it out of the overhead account and into work in process. If you go back to the flow chart, you'll remember that. Overhead allocation means that we move it out of the overhead account into work in process. Everybody good so far? So now what happens? We completed jobs 301 and 302. The totals were 51,250 and 71,500. A total of $122,750. But the question is, where does it go? Where does it come from and where does it go? When we finish up those jobs, it's going to come from which account?
In process.
Yeah, it's going to come from work in process. Oops. It's going to come from work in process because they're no longer in process. They are now in finished goods. Yep, they're now in finished goods. So we credit work in process. And again, I probably should be embarrassed that I keep putting up this hand-drawn flow chart, but it's what we have. So when we finish product, you can see it here as the cost of goods manufactured. When we finish product, we move it out of work in process and into finished goods. And that's this entry right here. Credit work in process, debit finished goods. Any questions? Keep going. Want to go to the PowerPoint just for a moment. Our next exercise is financial statements of a manufacturing firm. And what we are going to be producing in the next exercise is an income statement. So I wanted to show you this example of an income statement. When you look at this, it really looks no different than the multi-step income statement for a merchandising company. As we have discussed in chapter 15 already, what makes this a little bit more complicated is what happens in the background for a manufacturing company that was not needed for a merchandising company, and that is the calculation of the cost of goods manufactured. So cost of goods manufactured goes into the calculation of this cost of goods sold. They also point out for us here, just as a reminder, something we've already covered today, when there is an immaterial error in our factory overhead application, we would make that adjustment or correction right in the cost of goods sold. And so they're pointing out to us that's already happened here for this particular company. They made an adjustment because they had underapplied factory overhead, so they had to add a little bit more to make up that difference. Other than that, the formatting looks exactly like what we have seen since chapter 4 in financial accounting. Multi-step income statement, 3-line heading, name of the company, name of the financial statement, range of dates that it covers. All the financial statements except the balance sheet cover a range of dates. And so it needs to specify, is this for the day, week, month, quarter, year, what? Start with our revenue, subtract cost of goods sold. Again, the complicated factor is we have to calculate that cost of goods sold. To do that, we have to calculate the cost of goods manufactured. Next line, the first step in the multi-step income statement is gross profit, or what you will normally see referred to as gross margin. Then we subtract our operating expenses, selling, general, and administrative expenses. That's how we get to our operating income. That's the second step in this. We would typically see another step, which would be the application of income tax expense. As we saw in financial accounting, there are also some entries that you could see additional non-operating items below the operating income. That's not going to appear on what we're doing in this exercise. But as you're looking at the company that you chose for the annual report project, as you are looking at their financial statements, keep that in mind that you are likely to see additional information beyond just this basic format that we're seeing here. Let's go back to our exercise. So we could go through right now and fill in the headings. Revenues minus cost of goods sold gives us gross profit or gross margin. We then subtract our selling and administrative expenses. We're going to total those and subtract to find our operating income or loss. If it's a loss, I'll have to come back and fix that. So we need to be able to calculate that cost of goods sold. Look at this. Sold goods with a cost of $550,000. So they're actually not going to make us calculate that, but we are going to, for the final piece here, we are going to have to look at what happened in each one of those 3 inventory accounts to find the ending balance. So they may have made it a little easier for us on the income statement. We're still going to have to do the analysis of the flows through each of those accounts, just like what we have on that flow chart that I keep showing you. How about their revenues? Revenues earned by selling bikes is the 3rd bullet point up from the bottom. From there, you should be able to find their gross profit. Tells us specifically what they're selling and administrative expenses. Remember, we talked about last class, if it helps you remember to subtract, unless the exercise, unless the software tells us specifically to use negatives in some circumstances, it generally does not count it as wrong if you use the negative or don't use the negative. If it helps you, feel free to put in the negative in front of the expenses to remind you to subtract. Sometimes people forget that. And so we know that, again, the formatting of the income statement looks very much the same as it does for any other merchandising company. Could be a service company if it just said cost of services. What is challenging is determining where that cost of what that cost of goods sold is. Because in order to do that, we have to calculate the cost of goods manufactured. For this exercise, the more challenging part is to determine the inventory balances. And so what I'm going to do is put some T accounts on the screen. Hopefully people don't find it confusing if I kind of run over the writing because I want to put all 3 of them in here. So our 3 inventory accounts, materials, probably didn't need to make that one quite so big, whoops. Work in process. And the third one, of course, is finished goods. Whoops. And so now in each one of those T accounts, I'm going to track what happened. It does tell us this is their first month of operation. So just like in the last exercise, they've made it a little easier for us. There are no beginning balances. Of course, if there were beginning balances, we would just have to enter those on the debit side before we get started. When we purchase materials, I'm just going to go through each one of these bullet points. Purchase materials, $480,000. Those get added to the materials inventory account. When we use materials, what happens to them? We no longer have them in the materials inventory. These are direct materials, so they get added to our work in process. We incurred $125,000 of direct labor wages, so those also would get added to our work in process account. Applied factory overhead at a rate of 40% of direct labor cost. We take our direct labor cost, multiply by 40% or 0.4. The 125,000 that's in this third bullet point right here, incurred 125 of direct labor wages. So now we know what we added to the work in process account. Any other questions at this point? So what happened next? Well, we finished some of the stuff that we had been working on. When we finished that product, $578,000 worth, it tells us, it gets transferred out of work in process and into, oops, dear, into finished goods. And then the next bullet point tells us we sold product worth with a cost of $550,000. So now, to answer our final question, we simply need to balance each one of these accounts. And I know you know how to balance a T account. So I'm going to ask you to go ahead and do that on your own right now. Balance each one of those accounts and enter the balances in Part B. as most of you heard me say throughout financial accounting, I personally find T accounts an easy way to visualize what's happening in these accounts. If you're not so much into the T accounts and drawing things out like this, I would just remind you that in this chapter 15 folder, you have this page called Basic Calculations for a Manufacturing Firm. And what we just did for in T accounts here is written out for you. So if you forget, you're not sure, you're not comfortable, you just don't like using T accounts, you're welcome to refer to these calculations and simply plug in what you know. For our exercise, we didn't have any beginning balances, but all the rest of what's here is information that was given to you. And so you could have simply used those formulas if you find that a more pleasant way to go about this. One advantage to that is that you don't have to think about debits and credits. I personally find it unnecessary to try to separate debits and credits from what we're doing here. And we do some journaling. We've already seen journal entries in our first couple of chapters here and earlier today. There are some textbooks, some instructors who try to teach managerial accounting without using debits and credits. So it's aimed at more at the person who may not have a financial accounting background already. And for many of you, realistically, in your work life, unless you are going into accounting, and hopefully some of you are considering that, but if you are not, it is still likely in your work life, almost certain you'll see accounting in some form. But if you're not working directly in accounting, it is very likely that you won't have to think about debits and credits. And so using those formulas, you'll notice debits and credits don't come into that at all. You don't have to be able to track what's being debited and what's being credited. For this class, because financial accounting is a prerequisite for this, and because I know all of you have already had that portion of the textbook, the first half of our textbook, I feel very comfortable still using debits and credits. But just so you're aware, if you're not going into accounting, you probably don't need to be as well versed in is this a debit or a credit? Because managerial accounting is, as you know, more about the decision-making process using accounting information. Questions about what we did here in this exercise? Okay.
Yeah. I wonder how you got the 31.5 for.
Okay, yep. So in the work in process account, I had added in the direct materials, the direct labor, and then I applied the overhead at 40% of direct labor, so 40% times $125,000 in direct labor. Then the $578,000 was the amount that we finished. We completed those products and moved them into finished goods. To balance this account then, I added the 3 debits to find what's called the debit footing, and then I subtracted the credit to find the balance. So that 31,500 is this plus this plus this minus this.
Okay, gotcha.
I was just curious, for part B, for these inventory accounts, is it possible to have a negative value? Or is it not really realistic?
It's not realistic. The only way I can, the only place it would be possible at all, but extremely unlikely, would be in work in process. And the only way would be if we hadn't, if we hadn't if there's nothing left in there, we were done, it's the end of the year, we're done, everything's wrapped up. And we've made an error with the overhead and we haven't fixed that yet. So, that even happen. Not sure that could even happen. Couldn't happen in the materials account because those are exact amounts that we're moving into and out. There aren't any estimates in there. It couldn't happen in finished goods because what we're moving out of there is based on what we put in there. So, either one of those accounts could have a zero balance, and in a perfect, just-in-time, lean manufacturing environment, those accounts should be as close to zero as possible. But, in the real world, are they ever actually at zero? Probably not. I'd have to really think about whether it's even possible in work in process, but that's the only place I could even imagine that it could be possible, and it would be somehow related to that manufacturing overhead, which is an estimate. But it wouldn't happen. Anything else you want to talk about before we move on to our final exercise for this chapter? Okay. So our final exercise for this chapter, then it will be 2 chapters down, 12 to go. 15% of the way through the semester, as far as the work that we have to accomplish, so that's pretty cool. Job order cost counting for a service company. So we already saw in that hospital exercise a couple exercises ago, we already pointed out that we can use some of these principles for a service company. And so for this exercise, we're going to be more explicit about that. The Fly Company provides advertising services for clients across the nation. The Fly Company is presently working on 4 projects, each for a different client. So again, if they're using job order costing, they'd have a separate cost accounting sheet or job order cost card, a subsidiary ledger that they're accumulating the costs that go specifically to that individual client. They'll also have overhead costs that are incurred at a higher level and then get allocated out to each of those 4 jobs based on some cost driver. And we'll hear what that is in a minute. The Fly Company accumulates cost for each account or client on the basis of both direct costs and allocated indirect costs. One more note about that. So there aren't direct materials for a service company because they're not selling a product. They may have supplies, but remember our differentiation between materials and supplies. Materials become part of the product. Supplies are used up in the course of our business of doing our jobs, but they don't become part of a product. So by definition, a service company can't really have direct materials, although they certainly can have supplies. The direct costs include the charged time of professional personnel and media purchases of airtime and ad space. Overhead is allocated to each project as a percentage of media purchases. The predetermined overhead rate is 65% of media purchases. In other words, for every dollar that we spend on media purchases, we're going to allocate or assign 65 cents of overhead. On August 1st, the 4 advertising projects had the following accumulated costs. So we can see the 4 accounts there: Vault Bank, Takeoff Airlines, Sleepy Tired Hotels, and Tasty Beverages. Each one of those balances is going to include direct costs of professional personnel and media purchases, as well as allocated overhead based on the percentage of their media purchases. So they had 4 jobs in process already at the beginning of the month. During August, the Fly Company incurred the following direct labor. So that's the professional services and the media purchase costs related to preparing advertising for each of the 4 accounts. Let's see how many lines I have down there. Okay. at the end of August, both the Vault Bank and Takeoff Airline campaigns were completed. The costs of completed campaigns are debited to the cost of services account. So important difference here, because they're not selling a product, they don't actually have a finished goods account. Okay, just like they don't have a materials account because they don't have materials. They probably have supplies, but no materials. They have no inventory except the work in process. Letter A asks us to journalize the summary entry to record the direct labor costs for the month. So we're already told the direct labor costs right here. This is not anything new. Direct labor costs are going to be credited to salaries payable and added to work in process. So even though they don't have materials and they don't have finished goods, they do have a work in process inventory account. Everybody okay with that? Journalize the summary entry to record the media purchases for the month. Again, those are going to be allocated to a payable. Maybe we have to pay whoever the media providers are, television, maybe radio or print news media. And we're going to add those costs to work in process until those jobs are completed. I've made an assumption. I guess I could have put cash there. It doesn't tell us how we paid for them, but I made an assumption that we bought these with an agreement to pay later. It's actually kind of interesting that they gave us the cash account there because it does say we purchased them, so we could have credited cash. In my mind, that would not be incorrect because it doesn't actually tell us how those purchases were made. I would probably prefer that it said purchased on account. And I don't think it actually tells us that anywhere. Not that I see. I wouldn't have included cash on that list if I were working for Cengage. Letter C, journalize the summary entry to record the overhead applied for the month. And remember, we're applying overhead as a percentage of media purchases, and the predetermined rate is 65% of media purchases. So we know the media purchases were $2,130,000. So 65% of that is $1,384,500. How do we apply overhead? We credit the overhead account, we debit work in process. Everybody good so far?
Maybe just go over one more time how you got that.
Yep. Same question was asked here in the classroom. So the total media purchases were $2,130,000. That's rolled off my screen, but the total's right here at the bottom, right at the very top of my screen. So those are the total media purchases, and we apply the overhead at a rate of 65% of those media purchases, 65 cents per dollar spent on media. So $2,130,000 times 65% or 0.65. That's where that number came from.
Yeah, I actually thought you said 60%, so I was close.
Yep.
Okay.
Last piece then is to journalize this summary entry to record the completion of Vault Bank and Takeoff Airlines campaigns for the month. So we're going to be moving the cost of those campaigns out of work in process and into cost of services. It tells us right here, the cost of completed campaigns are debited to the cost of services. So it's Vault Bank and Takeoff Airlines. It's these first two here. We have the direct labor, the professional services. We have the media purchases. What we do not yet have is the overhead. And so I need to determine the overhead for those two accounts for the month. And I'm just going to stick this in where I hope it's not going to be in the way when I scroll down. So overhead is applied based on media purchases. We know how much total overhead was applied, but we do not have that separately for each job. And so what I need to figure out now is how much of that overhead that we just calculated, the $1,384,500, how much of that was applied specifically to Vault Bank and to Takeoff Airlines. So it's going to be the combination of media purchases for those two accounts. Oops. So that's $1,335,000 worth of media purchases times 65%, which is $867,750 in overhead applied. Finished. Everybody okay with that calculation? Just added up the media purchases for those two finished jobs, multiplied by 65% to find the total overhead. Then I can add that to what I have highlighted here on the screen, the direct cost, the direct labor and media purchases for each one of those two accounts, each one of those two jobs. If I added those correctly, $2,477,750.
Don't forget to add the balances.
Oh, they're, yes, thank you. So Drew just reminded me that they had also given us beginning balances. Totally forgot about that. Didn't scroll up that far. So I need to add those as well. So 270,000 had already been spent on Vault Bank in the previous period and 80,000 for Takeoff Airlines. Let me adjust those amounts, 2,827,750. Yes, we definitely needed to include those. I totally forgot we had beginning balances up there. Okay, so questions on that? So that's the beginning balance for each account plus what was added this month, direct labor, that's the professional services, the media purchases, and then the allocation of overhead at a rate of 65% of their media purchases. Questions at this point? Okay. So with 3 minutes to spare, we finished chapter 16. So you all know what you need to do. There are a couple people who still need to choose companies for your annual report project. Please make sure you do that. There are there's at least someone, maybe more than one person who has a 0 for that and needs to read my comments and choose a different company or adjust the company that you've chosen for some reason. So please make sure you check the My Grades area in Blackboard. And if you do not see a 5 for the company that you chose, if you still see the yellow thing, that means that I haven't gotten to yours yet. I've gotten through many, but not all of them at this point. All right. Well, thank you for being here. And if there aren't any questions, I'm going to stop the recording.